So what do private equity firms actually do? Great question, and we get asked it a lot. The insiders will give you the lowdown. We think the easiest way to boil this down is to walk you through what we call the private equity cycle, which looks something like this. At the outset, your PE firm sets their investment strategy, which will be the USP for the firm or a particular fund they're raising. For example, it will invest regionally or globally in small businesses or large ones, a specific industry, or a range of industries. Once this is set, the PE firm will raise their fund. Normally, they kick this off with a roadshow of meetings and presentations to attract reinvestment from existing investors and attract new investors with their killer investment strategy. You raise the fund, then close the fund once it's reached its target size. The PE firm will likely have been sourcing deals whilst fundraising and will continue to source deals through the investment phase of the fund. Deals are often sourced through a network contact or through an investment bank engaged to promote the sale of a company. An investment thesis may need to be written for the PE firm's investment committee so an initial decision can be made on whether or not to proceed. With a green light, terms are drawn up in negotiation with the seller, often re-reviewed by an investment committee, and simultaneously, financing and investment structuring work is done. The deal will then be closed when everything is signed and money has been transferred to the seller. PE firms normally aim to hold investments for 3 to 5 years. During this time, they implement their plan to best position the company for a sale. This can mean driving operational improvements like manufacturing efficiencies, expanding into desirable markets, or repositioning the company in the market. About a year before selling the investment, the PE firm starts to get the business ready for the kind of sale it wants, e.g. an IPO, a sale to a strategic buyer, or sale to another PE firm. They'll be drawing up the right story for the right audience. Check out our Storytime video for more detail on that. Then they conduct the sale process, normally the inverse of the buying process, except where the company is being IPO'd, which has a very different nature to it. Proceeds from the sale are routed up through the fund, back to the investors, and if eligible, the PE firms will take a slice of that profit through carried interest. And we've got another video on that. Normally less than halfway through the life of a fund, a PE firm is busy raising its next fund, which completes the cycle there. An offshoot is fund wind down. Once all investments are sold, all fees are paid, and proceeds are returned to investors, the fund is wound up. Typically, a private equity fund has a 8 to 10 year life cycle. And that's it, folks. A dramatically simplified overview of what PE firms actually do.